Nvidia came, Nvidia went, and the markets are in an interesting place. Same one they were beforehand. So now, what are we to make of what comes next? This is the subject of our conversation here today. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And finally, after a long week of sitting and waiting for something to happen to the market's favored macro narrative, the outlook for Fed interest rate cuts, we are looking at some substantive information, at least as far as the context of this week is concerned, for where that narrative will go. And this will be the first piece of that substantive information since basically the Jackson Hole Symposium last week. Now, of course, we've had a little bit of economic data here and there, but the actual view that has emerged on Fed policy expectations has not budged. This information has not moved the needle, as it were. In fact, we can see that basically, since the beginning of August, when we had that massive sell-off across markets, policy expectations haven't really gone a whole lot, either this way or that way. You can see they're basically pinned around the 2% level here for the sum total implied in Fed funds futures for this year. That's in the gray, and next year in the yellow. This, of course, makes for a very interesting sort of place to be. We can see here the sell-off that began in July began with the realization that Fed rate cuts were not just some future thing that would happen eventually, and the Fed could hold higher for longer because, in their words, the labor market was fine. But now rate cuts were becoming imminent because maybe the labor market was not fine. And that was the message that we heard all through July. Then, of course, as we got into the first days of August, the data seemed to start confirming that maybe not fine is the right way to look at it. First, we get a weak CPI number right after Powell comes to congressional testimony and tells them that the risks to the labor market now look about on par with the risks to inflation. And then we get that very weak jobs report that gets everybody hot and bothered. And we see here that while the sell-off starts relatively slow as the market goes, oh, the Fed is getting ready to cut, that probably means that they're seeing something in the economic outlook that's starting to feel uncomfortable. And then the data comes out, and we get that discomfort in spades. Sharp dovish adjustment in policy expectations and stocks, which had been reveling in sometime in the future rate cuts. You can see that from about mid-April through the end of June and into early July. Now they get spooked by a dovish shift because now the rate cuts are here, which means it's not so much that the Fed is going to give a bit of maintenance to the rate structure and, as inflation expectations decline, bring down rates to make sure that they don't over-tighten, even as inflation falls. No, this is the market going, oh, well, now they have a sense of urgency. That's probably not good news for the economy. And as the data confirms, this sell-off. Since then, we're basically hovering around these settings. Now, of course, the market has subsequently recovered a good way of the road back. Notably, it's stuck here short of this high. It isn't powering higher. In fact, it is sitting pretty much exactly where the breakdown initially occurred. As though the market panicked, thought better of it, but is still unnerved by the idea that something more immediate is happening with Fed rate cuts. And this really is where we find ourselves now. Having waited all week for something substantive on this front, we are finally going to get it with the release of July's U.S. personal consumption expenditure measure of inflation. And this is an interesting set of numbers because for the first time in quite a while here, we're looking for an uptick. And not just in the headline where you get some shenanigans with crude oil markets and food prices on global markets oscillating back and forth, but on the core measure. Which you can see here is what the Fed really cares about because most inflation here is not in food. That's negligible at this point. It's not in energy, a sliver here. In fact, goods inflation in general is at this point negative and actually pulling inflation down. The real culprits here are services and housing. And there's not a whole lot that the Fed is going to do on housing until it cuts rates. Its own rate hike cycle has essentially prevented housing costs from adjusting down because, of course, the average mortgage rate locked in the U.S., average outstanding rate, is below 4%. Meanwhile, the actual rates available for 30-year fixed mortgages in the market are close to double that. And so if you're a seller and you would have to refinance your next residence at twice the cost, not surprisingly, you're motivated not to be a seller, but to hold out and wait. And of course, if there are no sellers, then prices can't adjust down, which means that you've pushed out buyers as well. So until the Fed cuts rates and makes it somewhat more attractive for sellers to actually introduce some more inventory onto the market, this part of the equation is probably locked up. So the real action is here as far as near-term policy, and that is all about core inflation going down in that service sector. And if we look at what the expectations look like for this go-around, we're aiming for a core PCE reading here that nudges up for the first time in quite a while. That this would actually be the largest month-on-month increase since September 2022, and only the second increase between September 2022 and now. Otherwise, core PCE has been, as we can see here, steadily grinding lower. Now, at the headline, we are looking for a rise to 2.6%. That would be the first increase in that metric since March. Needless to say, the operative question, of course, is what is the Fed going to do with that information? Generally speaking, the PCE report tends to be relatively close to market forecasts when it comes out because you end up with the CPI and the PPI reports generally released before it. You can unpick those and reconstruct a PCE index fairly straightforward. And so as you look then at sort of market's ability to get their CPI forecast right versus their PPI forecast right versus their PCE forecast right, the PCE tends to be closer to as expected more of the time because CPI and PPI will have given the markets the key inputs they need to make that calculation. So we can surmise that some level of increase here is probably on the menu and that the markets have probably discounted as much. So why do we care about this, and will this change the calculus one way or another? Well, let's consider a few inputs first. The Cleveland Fed, the Cleveland branch of the Federal Reserve System, puts out a very closely watched nowcast for PCE. Nowcast is essentially a forecast that takes in inputs from incoming economic data in real time, and then spits out an updated forecast incrementally between one release and the next, and adjusts it as data comes in. Notice what we see here. At the top is headline PCE. In the blue is realized results, and the yellow is the forecast. On the bottom is core. Notice that if we look in particular at core, going since January, realized results have topped forecasts every single time. Now, it's not by a lot, but in January, February, March, April, May, all the way through the last release in June, the actual results have been greater, or to put it another way, the Cleveland Fed model has understated what is coming. And the Cleveland Fed model currently is pretty well aligned with forecasts. For the core, it has a 2.56 measure. For the headline, or rather for the core, a 2.64 measure, so closer to that 2.7 expected. For the headline, 2.56, so basically right on the nose with the 2.6 expected. Which is to say, the Cleveland Fed broadly agrees with markets, but the Cleveland Fed has been coming in light for 6 months in a row. So whatever is occurring with this model, that it's basically in line with the markets, and that it tends to be a little soft compared with what actually occurs, the implication seems to be that there is upside risk, even marginally so, on this PCE data. We can see, by the way, a similar dynamic emerging in headline. Notice, headline here, higher than forecast here and here and here and here and here and here. So the risk is that we go a little bit higher here on realized results than what is being baked in. That makes for an interesting update to this dynamic. The Fed likes to look at annualized 3 and 6 month inflation rates to get a sense of inflation dynamics as they're developing in realer time. Year-on-year metrics are, of course, the headline. That's what the Fed aims to target. But to see how things are trending, annualized 3 and 6 month numbers are in focus. And we hear Fed officials like Powell and, of course, many others cite these numbers, cite the 3-month rate, cite the 6-month rate. And what's interesting here, especially if we look at what's been occurring here, we can see while there's been a steady decline in year-on-year PCE, starting to get a little bit higher on core month-over-month numbers, but more eye-catching still. While the 3-month annualized rate seems to have set up some kind of a peak in March and has since declined, the 6-month rate has been rising since basically January. January marks an increase from December's number, and we've basically marched higher on these red bars ever since. Now, this is not the worst thing in the world that the 3-month measure has already rolled over. Would suggest that once you pull back to a 6-month average, you'll eventually see catch up in those numbers with some lag. So if the higher frequency thing has already rolled, then perhaps the slightly lower frequency or slower moving average, 6-month moving average versus the faster 3-month moving average, if the 3-month has rolled over, the 6-month probably follows. So it's not as troubling as it might appear, and it's not the kind of thing that would get the Fed to not cut rates, having signaled abundantly that it's going to do that. But again, it does suggest that this situation is uneven, that we don't have the kind of overwhelmingly convincing disinflation here that would have the Fed jump out the window and turn more dovish than the kind of cautious, gradual thing we've heard from them so far. Now, in fairness, that's not the only input data here. We, of course, also have the flip side of the story. This is from the S&P Global US PMI numbers, and this is the latest. And what we see here is an interesting dynamic. The input cost structure actually seems to be quickening a little bit, but that is not getting passed through as much downwind. So we can see here input prices going up, but companies seem to be eating them because output charges are actually moving lower, and indeed did so most critically for services yet again in July and August. So it does seem to be the case here that, at least according to the PMIs, output inflation continues to slow, and businesses are eating the difference. There's also the case that we've seen U.S. economic data consistently underperforming, and increasingly so, relative to baseline forecasts, according to this data from Citigroup, basically since middle of April, which creates a situation where you don't necessarily expect that every single release is going to miss forecasts, but you certainly get a sense of the tendency. There's a bit of an anchoring here, but still, essentially since late April, early May, U.S. economic data is biased to undershoot forecasts. And with that, we have downside surprise risk on these numbers, even as some of the dynamics here, be it the Cleveland Fed dynamics or the dynamics we get from the recent high-frequency rate of change numbers, this still suggests that there's downside risks rather than upside risks. And so there's a number of things that this implies. Number one, of course, there's two-sided risks around these numbers, which means that whenever they come out, somebody is going to be wrong, which makes for at least some amount of volatility back and forth. But secondly, there is an incremental possibility here for the kind of change that spooks markets one way or another. Consider here that as it stands, the Fed is expected to deliver something on the order of 80 basis points in rate cuts, 81 to be specific, by the end of this year. So here we are at the effective current Fed funds rate. That's 5.33 in the middle of the current 5.25 to 5.5 target range. It's a bit deceptive to say that September is at 5.2 because this doesn't appear to imply a rate cut, but of course, in order to get this accurately, you have to adjust for the fact that the meeting in September occurs on the 18th. So pretty deep into the month. Not surprisingly, by the time you get to November, you have 60 plus basis points in cuts. So not just 50 from here to here, but actually more. Now, there's not a Fed meeting in October, but if we look at where we are in between the September and November meeting, we can see, here's the implied October rate, we're at 5%, which means that by the time September is over, we've gone from 5.33 to 5. In other words, we've had at least one cut and some probability that actually we've had the equivalent of 2 or 50 basis points. In fact, if we consider here how much of that is already baked in, it's about 17 basis points of change. So one cut is there, and there's about a 68% chance that there is more. Now, if we fine-tune it down to the actual September 18th meeting, what you're looking at is about a 65 to 35 spread between the likelihood for a single 25 basis point cut and a double 50 basis point cut. This is where this gets interesting. The Fed has told us in almost no uncertain terms. Obviously, there's always a degree of vagueness around Fed forecasts. They don't want to paint themselves into a corner, but nevertheless, we have as clear of a signal as we're likely to get that September is on for some amount of rate cut. That's why the likelihood here is cumulatively 100%. But the market is still holding on to a meaningful amount of speculative interest in this 50 basis point cut. Now, this is where things get curious, because if you then have a situation where the Fed is opting for more gradualism and the 50 basis point possibility falls away, well, then you're looking at a situation where the market can have a dovish or a hawkish adjustment, in this case, a slightly hawkish one, in relative terms, without actually suggesting that the rate cut is somehow off the table. And if you get muddiness in the numbers, that is to say, this sets you up to surprise a little bit higher, and this is telling you that, yeah, the 3-month higher frequency numbers have rolled over, but it's not a uniform disinflation picture because the 6-month rate is still going in the wrong direction, perhaps more so if the numbers surprise higher, even modestly. Then at the very least, now that the Fed has talked themselves into a cut, it's going to be a 25 basis point cut, not a 50 basis point cut, which means this needs to get factored out of markets. And that represents a bearish risk. If you look then at what this has meant recently, markets have clearly rebounded as we've established a basis here. If we reshuffle to later cuts, then some of this optimism might be fragile. The other side of the equation comes from the US dollar, which has moved in pretty close lockstep with the expected rate cut tallies. We can see here, as we get more rate cuts into the outlook, the dollar falls. As we get less, it rises and generally oscillates around how many rate cuts the Fed is expected to deliver. So if it seems like the tally might get lighter because a 50 basis point move is off the table, well, then you probably get a stronger dollar, which sets up interestingly given where we are level-wise. Note, here's that July top where the Fed initially signals rate cuts are coming. We sell off because this generates some growth concern. And the sort of the panicky part of it is right here. This is US PMI data, spooking markets. This is the jobs report. This is the August 5th vol spike that follows as global markets take this Friday lead from week NFP data and run. Notice the up move is finally taken out here. There is a retest, then extension. We have now recovered basically to exactly this spot, which is to say, this panic was appearing overdone relative to what the markets have done since, but the top holds and the general narrative, maybe the Fed is cutting for the wrong reasons, that's in place also. So the market is not prepared to say we have the all clear. If we get a higher number on PCE and that takes the 50 basis point rate cut more so off the table, the move might be this way. And if we get a close through this support, perhaps we have room to start exploring in the direction of the 5,400 level. That, of course, amplified if you look at NASDAQ and so forth. And for the dollar, this is the benchmark euro contract, so call it the dollar upside down, we seem to have already established something of a top, clustered around the 112 figure here, rather. We found some initial support, but if we continue to go in this direction, and we do get that 50 basis point cut off the table, the next move here might well take us through the 110 figure and into this congestion zone, somewhere around the 109 figure and above in the relatively near term. And that is Macro Money for today. It's also the last of these shows for this week. Macro Money returns next week on Tuesday because, of course, Monday is the Labor Day holiday here in the U.S. Typically, we're here Monday through Thursday right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I'll be back with Chris for Futures Power Hour tomorrow, usually on Sunday, next week on Monday for First Call with Victor and Tom. Back with Victor for the Price of Truth on Wednesdays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week. Take care.